I'm going to tell you exactly how investing in stocks works so that by the end of this video, you're going to have a very solid foundation, which means that you're going to be able to get started much faster and you're going to become successful at it much sooner. I'm also going to tell you the one very common mistake that new investors make so that you're going to be able to bypass this costly mistake altogether. So let's get right into it. Hey everyone, I'm Richard Hopkins and welcome to another video. If you're new here and you want to learn how to invest in stocks successfully and reach financial freedom sooner, then start now by hitting the subscribe button and ringing that bell so you don't miss anything. So the question we're answering today is, how does investing in stocks work? So this is actually a pretty big question, and I want to make sure you fully understand what I'm about to explain to you, because if you don't, then you're going to end up using the stock market as some kind of gambling machine. You're going to end up losing money, and it's going to hurt, and it might even be so painful that it causes you to just avoid the stock market altogether for the rest of your life. And I don't want that for you, because investing in stocks is such a great way to build wealth. So listen up. A share of stock represents a fractional ownership interest in a company. This means that when you buy a share of stock, you become part owner of that company. For example, if I bought one share of Apple, I would be part owner of Apple. Now, my percentage of ownership would be very minimal, as you'll see in the example in a moment, but I would be an owner nonetheless. Tim Cook, the CEO of Apple, would technically be my employee. All of the shares of a company are collectively known as its stock. Another way to put this is that stock is equal to all of the shares that the ownership of the company has been divided into. As a side note here, mostly people use the words stock and shares sort of interchangeably. Like, I just bought Apple stock, or I just bought shares of Apple. When they're saying this, they're meaning the same thing. Let's go back to the Apple stock example. As of July 2020, Apple has 4.334 billion shares outstanding. This means if you went out and bought 1,000 shares of Apple, you would now own precisely 0.000023073% of the company Apple. That's pretty cool, right? So another quick side note here for you is when you're buying shares, you're buying them from someone else who owns those shares and who is making the decision to sell them. Buying shares does not mean you're giving money to a company or something like that. Although sometimes companies may decide to issue more shares as a way of raising money, in which case the number of shares outstanding would increase. But for the most part, when you're buying and selling shares, the party on the other side of that transaction is going to be another investor / shareholder. I don't want to cram too much information into this video, so if you want to learn more about what I just said, go check out this other video I made called Where Does the Money Go When You Buy a Stock? So as we were saying, Apple has 4.334 billion shares outstanding. And I want to make the important point to you right now that if you were to purchase all of those 4.334 billion shares, then you would own 100% of Apple. And listen up, because this is important. To buy all of those shares right now, it would cost you $1.58 trillion. This number is also known as the market cap, which is short for market capitalization. It's equal to the number of shares outstanding multiplied by the price per share. Market cap is just a fancy way of saying essentially the price tag that the market is putting on the company. So when you see market cap, think price tag on the entire company. By the way, if you've received any value from this video so far, please smash the like button for the YouTube algorithm. It really helps out and I really appreciate it. I'm also going to be reading every single comment and responding to as many as I can. So if you have any questions, please put it in the comments below because I will be reading them. So the goal of the successful investor should be to accumulate shares, or in other words, ownership in companies that have good long-term prospects, and also to buy those shares at sensible prices to what they're worth. I'm going to let you in on a little secret. Just because a stock trades for a particular price on the stock market does not mean that that's what it's worth. Warren Buffett likes to say, price is what you pay, value is what you get. Even buying shares of the most incredible company can be a bad investment if you pay too much for it. Think of that one again, this time in terms of as if you were buying the corner store. It might be a great investment if you pay a really great price for it, but it could also be a terrible investment if you pay way too much for it, right? Works the exact same way for stocks. What successful investors do is they calculate the intrinsic value of a company first by making a rational prediction of the future cash it will generate, and then they look on the stock market to see whether or not the price it's trading for is favorable or not. As you've just learned, because stock shares represent ownership in a company, it means that those shares have a calculable intrinsic value. So here's where the interesting part comes in, and it's also why the stock market is so awesome. The price that shares of stock trade for in the stock market is not fully efficient, meaning that sometimes what it's being offered for is not equal to its real value. It is mostly efficient because the price is going to be partially based on its intrinsic value. However, stock prices are also partially priced and valued by many investors, who in reality are actually just speculators, more like fine art, increasing in price mostly just because they've gone up so far. This is what can cause stock market bubbles. If you've heard of bubbles before, this is how it happens. Fear of missing out buying and irrational buying, people only looking at the price momentum, driving the prices higher and higher. The prices of stocks can often be driven to such ridiculous prices that have no real basis in reality whatsoever. I'm going to put this another way for you. Stock prices are determined by all the participants, investors and speculators alike, doing the buying and selling. They're partially valued as if they're cash generating assets, but they're also partially valued as if they're Pokemon cards or baseball trading cards or Picasso paintings. To learn more about this, check out this other video I made, Mr. Market, the Intelligent Investor's Best Friend. The fact that the stock market isn't perfectly efficient leads to sometimes stock prices being overpriced relative to their value. But it also means that sometimes stock prices are underpriced relative to their value. That's where the opportunity is. Warren Buffett and all intelligent investors practice something called value investing, which simply means acquiring more than you're paying for. Value investors look for or wait for the stock buying opportunities where they're buying stocks at a discount to what they're worth. Speculators, on the other hand, are treating shares of stock as if they're pieces of paper to be traded back and forth rather than as ownership in companies. These are the people that don't get it. And honestly, it's actually the majority of individual investors, and you don't want to be like them. You're going to be playing a total loser's game if you're valuing stocks as if they were baseball cards, because it means you're going to have to guess how large masses of people are going to behave. A speculator is essentially trying to guess what the price is going to be in the future by predicting what other people's behavior is going to be. Yes, even speculators are inevitably going to be right from time to time, but don't mistake a lucky guess as skill. Warren Buffett says this: if you're an investor, you're looking on what the asset is going to do. If you're a speculator, you're commonly focusing on what the price of the object is going to do. And that's not our game. So here's the bottom line. You've learned that a share of stock represents a fractional ownership interest in a company. You've also learned what market cap is. Remember, it's the price tag on a company. And you've also learned that you need to buy your stocks at sensible prices because paying too much makes for a bad investment. So now you're probably watching this video and you're asking the question, okay, so how do I calculate the intrinsic value of a company so that I know that I'm buying my stocks at a good price compared to what they're worth? And honestly, that would be another massive video. So if you want me to make that video, I can, but please comment below and let me know. That way I know how much interest there really is. Or if there's another video you'd like to see, please comment below and let me know that too. I do read every single one of these comments. So if you haven't already, like this video, subscribe, and ring the bell. And if you want to keep learning, I made this other video for you right here. So check that one out next, and I'll see you over there.